Okay, episode 2. Hey everyone, before we get started, I just want to say thank you so much for all the love and support on the first video. I think it got over 200 views, which is completely crazy to me because I honestly thought we were only going to get about 30 or 40. It gave me a lot of positive affirmation that I might be doing something right, and some of you actually texted me saying that you learned something and that was helpful. So thank you very much, and let's get into the video. The topic of today's video actually comes from my friend Savannah, who wanted to know the technical differences between a Roth IRA and a 401k. So in this video, I actually want to go over 4 main points. One of them is what are the technical differences and similarities between a Roth IRA and a 401k? What is the optimal investment strategy when you have one or both of these accounts? Why is it so important to start planning for retirement early? And lastly, going over a simple tool to help you visualize why it's so important to start planning for retirement sooner rather than later. To kick off the first topic, I'm going to give the definition of what a 401k is. Now, this definition does have some technical terms in it, but don't worry, we're going to go over each of them in depth to give you a better understanding. So, the definition of a 401k is a tax-deferred retirement account offered by an employer with a defined contribution and often an employee match incentive. Let's talk about that. To start off, a defined contribution simply means that at the time of signing your employee contract, you and your employer both agree to deposit money into your personal retirement account. Now, that amount is determined by the employee match in the contract. For example, let's say that your job decides to offer you a salary of $60,000 and your employer decides to match up to 5% of your salary. This means that 5% of your entire salary is $3,000 and your employer will contribute $3,000 into your personal retirement account. Now, not every employer decides to contribute 100% of every dollar that you put into your account. Maybe they only match 50% of every dollar you put into your account. So if your employer gives you an employee match of 5% and decides to only contribute 50% of every dollar that you put in, then they will deposit $1,500 instead of $3,000 into your personal retirement account. Now, when you make contributions to your 401k, that money is automatically withdrawn from your paycheck. Typically, the way that paychecks work is we have a salary or our gross income, we pay taxes on that gross income, and that leaves us with our net income. Our net income is the money that we are free to do anything that we want, whether it's saving or investing or buy anything personal for ourselves. Now, you might be wondering why you can't take your net income and deposit into your 401k yourself, and while you can, you won't get a pre-tax benefit that's also associated with a 401k, and we'll talk about that. So for this example, we're going to talk about 2 situations. In both situations, we are going to get a paycheck of $1,000, we're going to contribute $200 to our retirement account, and we're going to pay 30% in taxes. In our first situation, where there is no pre-tax benefit, we're going to get a paycheck of $1,000. We're going to pay 30% taxes, meaning that we have a net income of $700. Now we're going to take this $700 and take $200 from it to deposit into our retirement account, and that leaves us with a grand total of $500 left to do anything that we please. Now, in our second example, with the pre-tax benefit, we're going to reduce our taxable income. The way that we're going to do this is we're going to take our paycheck of $1,000, we're going to withdraw $200 and automatically deposit that into our 401k, leaving us with $800. We're going to pay 30% taxes on that $800, which gives us a total of $240 in taxes. Now, finally, we're going to take our original $1,000, subtract $200 for retirement, subtract $240 for taxes, and that leaves us with a grand total of $560. Now, even though we had the same paycheck amount with the same tax rate, with the same amount being contributed towards retirement, we were still able to end up with an additional $60 in our pre-tax benefit, all because we were able to reduce our taxable income, and all that it cost us was a little bit of forward planning. And finally, the last point I want to make about a 401k is that you don't generally get to make direct investment decisions with your account. It's typically managed by some third-party company, such as a financial institution. However, you do get to decide the general composition of your portfolio, such as do you want to have larger companies, smaller companies, international companies, do you want to have greater holdings in bonds, and all those types of decisions can be made entirely up to you. So next we're going to talk about a Roth IRA or an individual retirement account. I really want to emphasize the individual in IRA because unlike a 401k, which is managed by a third-party company, IRAs are completely funded and managed by yourself. If that worries you for any reason at all, because you've never invested in something before or you're not entirely sure what goes into the decision-making process and how to determine a good investment from a bad one, don't worry about that at all. It's honestly very easy to learn and there are plenty of resources that you can look at. I'm also personally thinking about making a video on that exact topic, so if that's something you're interested in seeing, please let me know and I'll make that video sooner rather than later. I definitely think it's super interesting. Another thing about the Roth IRA is that it provides a different type of tax benefit compared to a 401k. So unlike a 401k where it reduces your taxable income and that is a tax benefit that you get, a Roth IRA means that you make contributions using your net income. However, you don't pay taxes at the time of withdrawal when you're in retirement. Now, if that fact comes as a shock to you because you didn't know that you had to pay taxes, you actually have to pay taxes on any type of profit that you make from investments, and this depends on your income and how long you've been holding your investments, and this tax is known as capital gains. But the amazing thing about a Roth IRA is that even though you're contributing $100 to $300 a month right now, that's a lot less money than the hopefully hundreds of thousands or millions of dollars you'll have in retirement, and paying taxes on that amount is going to be significantly greater than anything you contribute right now. And finally, unlike a 401k, a Roth IRA actually does have some income restrictions. So if you make under $125,000 a year, you can contribute the full amount. However, anything more and you either have to contribute less than the annual limit or you're not allowed to contribute at all. There is a very common tax loophole known as the backdoor Roth IRA. It's very well published and something easy to do. I'm obviously not going to go over that in this video right now, but it's just a thing that exists. Now that we talked about the technical differences between a Roth IRA and a 401k, let's talk about some of the similarities. So a Roth IRA and a 401k both have an annual contribution limit, and these numbers are different depending on the account. So for a Roth IRA, you're allowed to contribute up to $6,000 for a fiscal year, and for a 401k, you're allowed to contribute $19,500 in a fiscal year. If you're not familiar with what a fiscal year is, it's different than a calendar year. So unlike a calendar year, which is from January to December, the fiscal year ends typically on April 15th at the time when you file for your taxes. Now, because it's not April 15th yet, you can still contribute to your 2020 Roth IRA and 401k, even though it is currently 2021. Next, the IRS imposes severe tax penalties for anybody that makes withdrawals from their retirement account before the age of 59 and a half. The reason why they do this is because they want to discourage anybody from treating their retirement account like their checkings and savings account. Now, even though the IRS imposes severe tax penalties for anyone that withdraws money from their retirement account before the age of 59 and a half, you actually have to make something called required minimum distributions at the age of 72. What this simply means is that at least once a year, you have to withdraw money from your retirement account, and this amount is a function of your age, so there are plenty of calculators that you can look at to figure out what that number is when the time comes. And if you're curious, the reason why the IRS imposes required minimum distributions is for a couple of reasons. One, at the time of you withdrawing money from your retirement account, you have to pay taxes, meaning the government gets some additional money. They don't want you leaving any of the funds as some type of inheritance for somebody else. And also, assuming that Social Security is even a thing by the time that we reach retirement, it is some supplemental income that you can survive off of and allows that money to be distributed to a greater population. Now, that was definitely a lot of information to go over, so let's summarize it right here. With a Roth IRA, you get a contribution limit of $6,000. It is completely funded and managed by yourself, and you get a post-tax benefit, meaning you don't pay any taxes at the time of withdrawal. Unlike a 401k, where the annual contribution limit is $19,500, you get a pre-tax benefit, some employee match, and it is managed by some third-party company. Now that we have a great understanding of a 401k and a Roth IRA, let's talk about the optimal investment strategy to plan for your retirement and start today. To get started, the very first thing that we need to consider is how much money we're actually going to need at the time of retirement. This value is obviously going to be very different depending on the type of person that you are and your lifestyle and where you live, but just know that if you want to have a more extravagant lifestyle, you're going to have to be more aggressive with your contributions, and if you're more modest and don't really need a whole lot, then you could be more conservative with how much you contribute. The next step is to actually have a Roth IRA and a 401k because we're going to take advantage of both of these accounts at different times in different ways. The first step is to have your 401k and figure out exactly how much you need to contribute to maximize your employee match. The reason why the employee match is such a phenomenal aspect to the 401k is because it is the only type of opportunity in investing where you get such a great return on the money that you put in for absolutely no risk at all. The second step after maxing out your employee match is to move on to your Roth IRA and continue to make contributions until your income no longer allows you to or until you max it out. After your Roth IRA is matched, you want to move back into your 401k and essentially repeat our step before. You want to contribute until your income either no longer allows you to or until you max it out. The very last topic in this video I want to go over is a tool that I created in Excel, which yes, I love Excel. I'm absolutely one of those people, but it gives you a very good visualization and representation of why it's so important to start planning for retirement as early as possible. Obviously, you're going to have to make some adjustments that are suitable to your specific situation, but you have the option to enter your salary, decide what percentage of your monthly income you want to contribute to retirement, make your own assumption about what your annual return will be, your contribution rate, and the employee match. And what this will tell you is how much money you'll have in your retirement account at the end of the year, or at the end when you actually reach retirement. So what this tells me now is if I have a salary of $60,000, I make a monthly contribution of $350, and assuming a 7% return, at the end of retirement, I will have a grand total of $2.2 million for only contributing $350 a month. And just like this tool, if you have any feedback on any of the content that I'm creating or have ideas or recommendations for stuff I should be going in the future, please let me know. I want to do everything I can to be a good, reliable, and helpful resource for you guys moving forward for anything that's personal finance related or professional development related. I absolutely love and enjoy talking about this stuff, and I want to do everything I can to help you. So thank you so much for watching. If you really thought it was helpful, I get to do the YouTube thing where I say, please like, subscribe, do whatever you gotta do. If you don't want to, that's fine. It just means I'll work harder in the future and make something great. So I'll win you over eventually. Have a great day and bye.